8 years ago, I discovered the FIRE movement and stood at a critical crossroads that every aspiring early retiree faces. Do you follow the traditional path, building a massive nest egg to live off the 4% rule? Or do you take a different road, building a portfolio of dividend stocks designed to pay you for the rest of your life? This single decision will define not just your finances, but your entire retirement experience, determining your stress levels, your lifestyle, and ultimately your legacy. Today, I'm breaking down exactly why I rejected the standard FIRE movement playbook and chose dividend investing, sharing the raw data and the personal reasons that could completely change how you plan your own financial future. This isn't just about retiring early, it's about building a retirement you actually want to live. Part 1. Price growth versus paychecks. The hard numbers. I want to start with something that might shock you if you've never seen the data laid out like this. When we talk about the market, we are usually looking at the S&P 500 price chart. And since 1957, it has been an incredible story of growth up and to the right. At the same time, there's another chart, the S&P 500's dividend per share. It's also a beautiful chart, also up and to the right. But they do not tell the same story, and the difference between them is the core of this entire decision. Let's get one thing straight right away. If your only goal is achieving the biggest possible number in your account, history is clear. Since 1957, the share price of the S&P 500 has grown by a staggering 11,000%. In that same time frame, the dividend growth has been just under 4,000%. Objectively, a total return strategy which captures that massive price growth has created far more wealth on paper. So if you watch a video where someone only praises dividends without acknowledging this fact, they are doing you a massive disservice. You need to know that if you focus only on income, you are likely sacrificing a significant amount of potential growth. That is a fact. But that's just one side of the coin. Looking at a 67-year chart in hindsight is easy. Living through it in real time is a completely different battle. Let's look at volatility. How often does the S&P 500 price actually go down? Since 1957, the market has finished the year in the red about 30% of the time. Think about that. For nearly 1 out of every 3 years of your investing life, your portfolio's value is going to be lower than it was the year before. That is a brutal emotional roller coaster to ride, especially in retirement. Now, let's look at the dividend chart. In that same 67-year period, how many times did the actual dividend payout from the S&P 500 go down? Less than 10% of the time. While the market price was dropping nearly a third of the time, the actual paychecks kept rolling in and growing almost every single year. One chart is a jagged mountain range of peaks and valleys. The other is a steady upward climb. So right here, we have the central trade-off. This is the fundamental choice you have to make. Path 1 is the total return strategy. You accept gut-wrenching volatility for the chance at the highest possible growth. Path 2 is the dividend income strategy. You consciously sacrifice some of that explosive upside in exchange for consistency, predictability, and a much smoother emotional ride. The question isn't which one is better on paper. The question is, which one can you actually stick with when the market is crashing all around you? Part 2, the dividend playbook, the pros and the cons. Let's break down the case for dividend investing. First, the pros. The single biggest advantage, the one that lets you sleep at night, is lower volatility. As we just saw in the data, dividend payouts are incredibly consistent compared to the wild swings of the stock market. Retirement is meant to be stress-free, and knowing that your income stream is stable even when the market is in a free fall is a powerful emotional anchor. In down markets, investors flock to safety, and dividend stocks are that safe harbor. The second pro is a game changer. You have no sequence of returns risk. This is the kryptonite of the 4% rule. Imagine it's 2022. The market is down almost 30%, and you need to sell 4% of your portfolio to live. You are forced to sell your assets at rock-bottom prices, permanently damaging your portfolio's ability to recover. With dividend investing, you are never a forced seller. You are a collector. While the market is crashing, you are simply collecting your monthly paychecks, waiting for the storm to pass. You are immune to the market's terrible timing, even if the dividends are smaller in a crash. The third pro is about legacy. With dividend investing, you are building generational wealth. You're not spending down your principal, you're living off the fruit that the tree produces. This means the tree itself, your core investment, remains intact. You're building a financial engine that can be passed on to your family or donated to a cause you believe in, creating a lasting impact long after you're gone. Now, for the cons, and you have to take these seriously, the first is that tax planning can be a nightmare. Your income isn't a fixed salary. You might have money coming from real estate investment trusts. Other options can include Roth IRA contributions, all taxed differently. This makes it incredibly difficult to predict your exact annual income, which is a massive problem if you're trying to qualify for healthcare subsidies under the Affordable Care Act. If you miscalculate your income, you could be on the hook for a huge unexpected tax bill. The second con is that dividends can and do get cut. These paychecks are not guaranteed. Great companies can be disrupted. Just look at former dividend stalwarts like Walgreens or AT&T. They had impressive track records, and then, facing business headwinds, they slashed their payouts. Your income is never 100% secure and can drop overnight if one of your core holdings gets into trouble. The third con is the price you pay for stability. Your upside is limited. We saw it in the data. A dividend-focused portfolio is not designed to capture the explosive, market-defining growth of companies like Nvidia or Tesla. By definition, you are under-allocated to the high flyers. You are consciously trading that lottery ticket upside for the consistency of the monthly paycheck. Part 3, the total return playbook, the 4% rule. Now let's flip the script and look at the traditional financial independence, retire early strategy, the 4% rule. First, the pros. The biggest advantage here is control, specifically control over your taxes. With the 4% rule, you are the one who decides your exact income for the year. In January, you can sell exactly $80,000 worth of your ETFs and, with absolute certainty that your income for that year is $80,000. This makes tax planning incredibly simple. You can perfectly target a specific tax bracket or hit the precise income level needed to maximize your healthcare subsidies from the Affordable Care Act. The second pro is massive. You get full, unapologetic participation in the growth of the entire market. When you own a simple, broad market index fund like VTI, the Vanguard Total Stock Market, ETF, you own everything. You automatically own a piece of every high-flying growth story. You don't have to worry about missing out on the next Nvidia or Tesla because you're already invested in them. Your portfolio is a true survival of the fittest system. As companies innovate and become market leaders, their weight in your portfolio grows automatically. You are capturing 100% of the market's upside, not just the slice of it that pays a dividend. The third pro is the beautiful simplicity of the planning phase. The goal is crystal clear and mathematically elegant. Accumulate 25 times your annual expenses. That's it. If you need $60,000 a year to live, your target number is $1.5 million. This gives you a single, concrete number to aim for during your working years. Part 4, my final choice. Why I rejected the 4% rule. So after laying out all the facts, the data, and the pros and cons, why did I personally choose dividend investing over the 4% rule? Because at the end of the day, this decision is not made on a spreadsheet. It is made in your head and in your gut. Investing is a psychological game, and you have to choose the strategy that you personally can stick with when everything is on fire. For me, dividend investing won for 3 very specific reasons. The first reason was the sense of control. I never wanted a boom or bust retirement. The idea of watching my life savings get cut by 30% in a bear market and then having to tell my family we need to slash our budget was my definition of a nightmare. That is not freedom. That is being a slave to the market's whims. I wanted to have control over my outcome. By focusing on the dividend income my portfolio generated, I felt like I was in the driver's seat. My goal was never to 10x my portfolio, My goal was a stress-free retirement, free from the anxiety of daily market swings. The second reason ties directly into that. My entire focus shifted from the share price to the dividend growth. This is a massive mental unlock. Instead of obsessing over when to sell my shares, my new scoreboard became the growth of my annual income. When the market crashes, it does not matter to me because I am not selling. In fact, it is an opportunity. My focus is entirely on the durability of my companies. I am looking at businesses like Coca-Cola or Procter & Gamble, companies that have relentlessly grown their dividend payouts through every recession and crisis imaginable. And the third and most important reason for me was the goal of creating generational wealth. I know some people in the financial independence, retire early movement have a goal of dying with zero. That is not my goal. My wife and I have 2 kids, and a core value for us is to be able to pass on the results of our hard work and sacrifice. Dividend investing is a strategy of preservation. You live off the fruit, but you never cut down the tree. My goal is to leave that tree, our capital, bigger and stronger than when we started, so that it can provide for our family and for causes that we care about long after we are gone. For me, that is the ultimate definition of building a successful life, and it is the single biggest reason why I chose the dividend investing path. If you've made it this far, I've got a powerful dividend investing starter guide made just for you, and it's completely free. Inside, you'll find a simple step-by-step plan to start building your own income-producing portfolio, tips on avoiding the most common beginner mistakes, and even a printable tracker to watch your dividends grow month after month. All you need to do is comment dividends on this video. Once we hit 50 comments, I'll share the download link for everyone. Now, if you think choosing between dividend investing and the 4% rule is eye-opening, wait until you see the actual financial numbers of the average person. Some of these stats will shock you, and they might just change how you look at your own retirement plan. Click over to my next video to see the truth for yourself.